decision-making. Peter will be taking you through our journey of success and market dynamics, in addition to recapping for all of you the key pillars of our investment case and to highlight the most important updates of our business during the period. I will then highlight and relay our latest guidance to you, after which we'll open up the floor for your questions. So just before we begin, a small public service message. If we turn to slide 3, I would just like to remind you that during today's call, we will discuss a number of forward-looking statements, which will be based on our estimates and expectations. These statements, of course, are not a guarantee of future performance, and actual results may differ. So with that small message, I will now hand it over to Peter to begin our walkthrough.
Yeah, thank you, Ruben, and welcome everybody to our presentation. Let me start our presentation by providing an overview of our company. CGS is dominating the transport refrigeration market in Saudi Arabia and is the only company in the GCC that provides solutions for the entire cold chain, from process refrigeration plants to cold room warehouses, and of course the transport solutions needed to distribute all the perishable goods. In a recent market study, the KSA economy is losing 38% of all locally produced goods due to cold chain insufficiency. With government investments of nearly 40 billion riyals supporting local food production, it is easy to recognize the economic impact CGS can have in the kingdom. But CGS is not only a cold chain specialist. We utilize our extensive engineering competence to develop and manufacture highly specialized solutions for a variety of industries. Next slide, please. Looking at CGS today, it's important to recognize the strengths of the foundation that has been built over 5 decades. We are looking forward to celebrate our 50th anniversary later this year. We operate with a workforce of 500 skilled employees, supported by 4 strategically located facilities and mobile service solutions, serving a customer base surpassing 3,000 across diverse sectors. These are not just numbers, but they truly reflect the business with solid operational capacity, extensive market access, and very importantly, long-standing customer trust. Our exclusive distributor status with Carrier Transicold is very important as well. We are Carrier's oldest partner globally, which is a clear evidence of how strong and mutually beneficial this partnership is. We continuously localize solutions for diverse industries. I give you 3 examples. CGS has protected STC telecom equipment for the KSA mobile phone network. We are the first local company that can produce ambulance vehicles to the demanding specifications of the government. And we are the first company that locally produces entire labor communities for the oil and gas industry. CGS has continuously focused on investing in advanced technologies. CGS is the only company in the GCC that utilizes open pouring technology to produce panels. This technology is globally considered current state-of-the-art manufacturing technology. We also use robotics and Industry 4.0 technologies in our manufacturing facilities. All of these technologies help us to be an employer of choice for Saudi nationals who want to pursue a career in manufacturing. Our extensive product portfolio, our engineering expertise, and our proven understanding of the GCC ambient conditions gives us the flexibility to cater to varying demand across critical sectors such as food and beverage, healthcare, defense, energy, telecom, and other industries. This enables us to remain resilient through multiple industry cycles. It is very important to recognize that these milestones illustrate a consistent pattern. CGS identifies structural needs early and develops localized, technologically advanced solutions that become industry benchmarks. Let's move on to our strategic review. Before we dive deeper into the dynamics of the market and business updates, I want to pause and highlight the fundamental strengths that underpin CGS's long-term investment case. Please look at attractive market dynamics and aligned with 2030 megatrends. Our markets are supported by structural, long-term tailwinds ranging from food security and healthcare expansion to tourism, defense localization, and industrial transformation. What sets CGS apart is our direct alignment with these megatrends that are helping shape the future of the kingdom. We will discuss this in more details in the next slide. I now point to market leader in high growth segments. Our unmatched experience and innovative product offerings enable us to capture significant market shares, such as 45% in transport refrigeration over the last few years and 7% in stationary refrigeration solutions. Our strong market position is not based merely on legacy, but rather on consistent execution, technological capabilities, and trust earned over decades. The critical differentiator for CGS is our nationwide service footprint. We operate an unparalleled service network that covers 96% of Saudi Arabia's population. It also provides a significant entry barrier for any potential competitor. Now look at use of cutting-edge technologies. Our competitive edge is not just in what we manufacture, but how we manufacture it. Across our facilities, we have embedded advanced technologies to improve output, reduce costs, and elevate product quality. I mentioned before the technologies that CGS is using to create a significant competitive advantage. But we don't stop here. We are deploying approximately 150 million riyals to build a high-tech manufacturing hub in Al Kharj, an investment that further strengthens capacity, enhances precision, and significantly improves scalability. Most important is our well-articulated growth strategy and balanced business model. Our strategic vision is clear. We drive long-term, high-quality growth through technological innovation, operational excellence, and market expansion. We achieve this with three key strategic pillars: manufacturing leadership with highly automated industrialized processes, product and market diversification, with expanding our product solutions from traditional cold chain offerings into higher margin sectors and tap into structurally growing markets and operational efficiencies, and operational excellence with implementation of lean principles. And finally, we demonstrate a strong financial performance and debt-free position. Our financial foundation is robust, with healthy profitability, a strong balance sheet, a debt-free position, and disciplined capital allocation. Ruben will explain more in detail about this in a few minutes. For you as interested party, it is very important to understand the following. These 6 pillars articulate a clear investment story. CGS is a leading company operating at the intersection of structural growth tailwinds with the scale, capabilities, and financial strengths to continue to grow. I mentioned before how strong our business activities align with Vision 2030. Our business objectives support broader national priorities around industrial diversification, localization, and advanced manufacturing capabilities. Saudi Arabia has committed approximately 40 billion riyals to strengthen food security and local agriculture. This leads to significant increase for refrigerated logistics, temperature-controlled warehouses, and food processing facilities. The kingdom is targeting 50% localization of defense spending, with a $250 billion riyals allocated. Some of these investments flow into specialized mobile units and highly complex shelters. CGS is ideally positioned to help global defense contractors meeting the localization requirements of the government. Saudi Arabia is also expanding its healthcare footprint with 8 new medical cities, serving 200,000 plus Hajj and Umrah visitors annually. Demand for ambulances and medical transport alone exceeds 300 new units during peak seasons, supported by a 30% rise in population by 2030. In summary, the megatrends shaping Saudi Arabia's economic transformation are directly aligned with CGS's core competencies. These positions us not only to grow, but to capture high-value demand across key sectors as the kingdom accelerates towards Vision 2030. Here we highlight our key milestones during the period, which reinforce the strengths of fundamentals, the scalability of our model, and the accelerating demand across our core segments. We consider our successful listing on Saudi Stock Exchange a strategic transformation in the company's journey, improving our corporate visibility among institutional investors and positioning us competitively in the market. Most importantly, our backlog almost doubled from FY25, which is an exceptionally strong level of growth, providing long-term revenue visibility. This growth was driven by rising demand for our products and services and the continued trust from our valued business partners. We continue to be awarded large, high-quality contracts that reflect our strong capabilities. Sanad awarded a 166 million riyal contract for customized solution, demonstrating trust in our offerings and in our capability to deliver at scale for complex and specific requirements. Al-Marai awarded a nearly 30 billion real contract for a food processing facility in Jeddah, and we are proud that the leading food and beverage player in the region continues to choose CGS for its needs. One of the most strategic developments this year is our advancement in the defense sector. CGS received an order for an EMP protected prototype shelter, making this the first of a scalable solution for major global defense players and positions us meaningful long-term participation in a sector aligned with Saudi Arabia's defense localization strategy. The mobility segment continues to show good momentum. We have delivered our first 8 ambulances to customers and secured orders for 10 additional units, reflecting rising demand. All of these developments demonstrate that CGS is not only capturing immediate opportunities, but is also building the foundation for sustained, high-quality, multi-sector growth. I now hand over to Ruben to discuss our financial performance for Q3 of fiscal year 26.
Thank you, Peter. Turning to our financial performance for Q3, we delivered strong and consistent results that reflect both operational execution and robust market demand as we step further into this year. As you can see, revenue reached 148 million in the quarter, in line with Q3 the prior year. What's important to highlight here is the sequential growth momentum from quarter to quarter. Q3 saw revenue increase 49% versus the prior quarter, Q2, and 67% versus Q1. This demonstrates our conviction that order intake timing would fundamentally mean that the second half of fiscal year 26 would be much stronger than the first half. Profit reached 30 million with a gross margin of 20%. This is driven by changes in the revenue mix, as we had a larger share of revenue in Q3 this year coming from stationary refrigeration than we saw last year. And we know as a team that stationary refrigeration carries lower margins than our other segments in the business. Net profit reached 14 million, reflecting a 10% margin, which represents a bottom line that remains structurally solid despite higher overheads. And speaking of these overheads, the increase in our indirect expenses is deliberate and strategic, driven by investments in new roles as we transition from a private entity into a listed one, as well as expansion of our board of directors, enhancing our governance post-listing. The secondary impact on our indirect expenses was one of timing, namely our increase in bad debt provisions in Q3. It's important to note, however, that this doesn't reflect any structural change in our receivables, with 80% of our receivables still being less than 90 days aged at the end of Q3. And this ratio is in line with how we ended fiscal year 2025. Let me walk you through our year-to-date performance as well. Starting with revenue, we closed the period at 335 million, compared with 364 million year-to-date fiscal 25. This 8% year-on-year gap is driven by the timing of our order intake, which has shifted a portion of our expected FY26 revenue into the subsequent period. It's important to reiterate here from my side that our position is that this variance is timing related rather than reflective of any changes in underlying demand in the marketplace. Moving to gross profit, we delivered 75 million this year versus 86 million in the prior year period. Gross margin remained strong at 22%, signaling that pricing discipline and cost structure remain intact despite the revenue timing shift. For net profit, we reported 33 million compared to 49 million in the prior year period, and we see that net margin softened from 14 to 10%, consistent with our Q3 results, with the decline being attributable to both lower volume year over year, as well as the increase in indirect expenses for the topics I mentioned already when we were discussing the Q3 performance. Now let's move to the revenue composition. This will give you hopefully more insight into what I just mentioned and to see how our portfolio mix is continuing to evolve. What you'll see on this slide is the continued execution of our strategic push for diversification. Historically, our revenue was heavily concentrated in automotive solutions. However, with time, we've successfully expanded our reach into the stationary refrigeration and customized solution segments. This meaningful shift towards a more balanced portfolio, we believe, helps reduce cyclicality in the longer term and de-risks our business with respect to over-reliance on any individual business segment or customer group. We've seen consistent growth in stationary refrigeration, which represented 14% of our top line in fiscal 22 and almost doubled to 27% during this most recent period, reflecting increasing penetration in a segment where we see strong structural demand in the coming years. Very importantly, this is not only about the point-in-time revenue the stationary refrigeration segment provides, but this is a key enabler to drive further aftermarket service expansion well into the future. Customized solutions has also grown. While this segment remains a smaller contributor today, it will play a critical role in expanding volume and margins with the introduction of newer products and the resulting revenue streams we're expecting. What's notable is that despite the change in mix in recent years, our gross margin levels have remained in a healthy low 20s range. Turning our attention now to cash. We generated 12 million year to date in operating cash flow. While this is lower than the exceptionally strong 89 million we delivered in the full year fiscal 25, the variance is primarily driven by revenue timing and, to a much lesser extent, some short-term shifts in customer payment behavior. It's crucial to highlight here that our current cash flow results are directly connected to our working capital position, which reflects anticipated record revenues for Q4. The build-up for today and the largely concentrated in inventory, both of which are aligned with increased business activity expected in the final quarter of this year. Looking at our working capital days, all key ratios remain within or near guidance levels, demonstrating strong operational discipline. The clear conclusion here that our working capital cycle remains healthy, controlled, and strategically positioned for the expected revenue uplift in the final quarter this fiscal year. Now let's look at our balance sheet position. Starting at the top, our total assets increased 18% to 352 million at the end of December. This expansion reflects the working capital buildup I just mentioned earlier, primarily to support anticipated record Q4 activity. The increase is concentrated entirely in current assets, which grew by 35%, 222 million. A significant component of this is inventory, which we increased in preparation for a busier than usual period in Q4 to ensure supply chain continuity and provide us with the ability to ensure timely fulfillment for our valued customers. Cash remains stable at 67 million, despite the rise in inventories and receivables, reflecting disciplined liquidity management. On the liabilities front, current liabilities increased 27% to 139 million, primarily due to the higher payables aligned with the inventory procurement and production activity I mentioned earlier. Non-current liabilities remain stable, increasing very slightly, 1 million to 27 million at the end of the period. Overall, our balance sheet remains healthy, liquid, and well-positioned to support our business. The rise in working capital is fully in line with our operational execution cycle, and the strong equity position provides a solid foundation for our future expansion. Now, let me walk you through our backlog position and how it underpins our revenue visibility. And I'm sure that for many of you, this will be the most interesting slide in the presentation. Starting with the left side of the page, this shows our current backlog and our expected remaining order intake. And what this shows is that we have sufficient backlog and expected order intake to fully achieve our fiscal year 2026 guidance, with a solid mix of confirmed orders and high probability wins across our core business lines. When you then convert that to the right side of the page, this shows how this backlog is expected to convert into revenue over the coming period. So as of Q3, as you saw earlier in the presentation, we've already recognized 335 million in revenue. And as we look ahead to Q4, we expect automotive solutions to deliver revenue in the range of 80 to 95 million, supported by the order book we've already secured and the high probability wins that I mentioned. We expect stationary refrigeration to deliver revenue in the range of 60 to 70 million, and this is fully secured and in our backlog today. And the remaining 45 to 55 million, we expect to come from customized solutions and our service business, also for the most part, fully secured. Vitally important is that our backlog not only helps us to see what we need to deliver for the rest of this fiscal year, but it helps us to see beyond this fiscal year. As you can see on the right side of the slide, we have 60 to 80 million of stationary refrigeration revenue already secured for fiscal year 27, as well as 80 to 90 million of customized solutions revenue secured for fiscal year 27, with a further 40 to 50 million of customized solutions revenue secured for the following year, fiscal year 28. So essentially, our backlog is robust, diversified, and provides strong ability beyond this year into fiscal year 27 and even into fiscal year 28, which we believe demonstrates the strength of our market position and the sustainability of our sales pipeline. Last but not least, let's discuss our year-to-date performance against our updated full-year guidance. Starting with revenue growth, we saw that we closed the period with a decline of 8% year over year. which is below the revised guidance of 4 to 7% growth. As highlighted earlier, this variance is driven by timing and order intake, with a meaningful portion of our delivery shifting into Q4. Based on the backlog and visibility we now have, we remain confident in achieving this full year range. Moving to margins, our year-to-date gross margin stands at 22% and EBITDA margin just over 13%, comfortably within the range of the full year guidance. This is a reflection of our operating model with disciplined pricing and stable cost structures, as I mentioned earlier. In terms of CapEx, we've spent 1.4 million year to date versus the full year revised guidance of 2 to 2.5 million. This is below our initial guidance in terms of CapEx, and this reduction reflects the timing of execution as we've deferred certain investments to ensure that we have the needed production uptime for our anticipated record Q4 volumes. In terms of investment into our expansion project, I mentioned in earlier period that we were anticipating starting to spend some money in the very back end of our Q4 this year. This will also be delayed into fiscal year 27 as we work to ensure the optimal financing sources for that project. Looking at working capital, all three key ratios remain within or near the guided full year ranges. While working capital is temporarily higher due to inventory buildup ahead of our busy Q4 period, the metrics remain controlled and consistent within our operational requirements. So overall, despite the revenue timing impact, the company is on track to achieve its targets across key financial metrics, as you see here. Our strong backlog, margin stability, and working capital discipline will enable us to meet our revised full year FY26 guidance. Thank you for joining us today and sticking with the formal part of the presentation. And with that, we conclude our presentation segment of the session. We'll now open the floor for your questions.
Thank you. If you would like to ask a question, please press star followed by 1 on your telephone keypad. If you would like to remove your question, please press star followed by 2. When preparing to ask your question, please ensure to unmute yourself locally. If you have joined online, please use Q&A chat box provided. We'll pause for just a moment. We have a question from Abdul Rahman Al-Baikan of Jadwa Investment. Please go ahead.
Yes, hello, gentlemen. Am I audible?
Yes.
Yes, hi, good afternoon. First, I want to congratulate you on the listing and your first earnings call. We have a few set of questions. First of all, starting with your guidance, I just want to get an idea about your comfort in this Q4 guidance because the revenue figure is pretty strong, and honestly, we were expecting stronger numbers, at least for Q3 in terms of profitability. So just we want to get an idea about your confidence and comfort in both the revenue figures as well as profitability in Q4. How comfortable are you in achieving the guidance?
Peter, should I take that question?
Sorry, I was on mute. Would you like to take that, please, Ruben? Yes.
Yes, no problem. So, I just showed you a slide on our current backlog position. And with the remaining time we have left in this fiscal year, we now have very strong clarity where we're going to land. So to answer your question, we are very confident in that growth that we just showed you. Based on the ranges we gave you for the different segments, you can see that it's going to be a record quarter for us for top line. And because the top line is going to be so significant, we expect that to also translate through to the net profit because our indirect costs are relatively, let's say, equally spread across the quarters, right? So with such a strong amount of volume going through in Q4, we expect our net margins to be, of course, higher than the full year, average and where we will end up. So yes, to answer the question, we are confident to meet the guidelines, the guidance we just put up on the screen. From our side, that's clear.
I see. That's very clear. Yeah, and just in terms of, you mentioned mentioned the indirect cost on the OpEx level. We just want to get an idea how much of that is going to be recurring going forward, and how much of it is a one-off, and as well as the ECL or bad debt provision. Could you quantify that either for the quarter or for the period?
Yeah, so I can definitely quantify. So let me start with the bad debt. So in the quarter, we took a 900,000 charge to the P&L, and year to date, through the first 3 quarters, it was 1.6 million, 1.7 million. If this is as I mentioned. Sorry.
Ruben, you were breaking up. If you could repeat that, please.
Yeah. So I'll start again. Sorry about that. So we took a charge of approximately 900,000 in Q3 for bad debt provisions, and year to date we've taken approximately 1.7 million. And I can tell you structurally nothing's changed in our receivables, as I mentioned. So if we look at how we ended last year, we ended with a really, really strong outcome. At that point last year, March 31st, 2025, 80% of our total receivables were less than 90 days aged. At the end of December this year, Q3, 80% of our receivables are less than 90 days aged. So nothing structurally or fundamentally has changed in our receivables, but some of the age things have moved around in the aging buckets within that. So that's why I say this is temporary. It's timing driven, based on having those items, collected from the customer side. So we're confident that is timing related, and that will come back to us. If not in Q4, then of course in the first half of FY27. That's certainly our focus, and nothing that we're worried about on that front. In terms of the other costs I mentioned, the investment in new roles, the expansion of the board, of course, that's not one-time impact. That's an ongoing impact as a consequence of having, an organization that is, public company ready to deliver all of our commitments and obligations around, governance and, the expanded roles that we've added to make sure that we can deliver. That will continue. That's going to be built into our baseline. If you look at how much of an impact that's had year to date, that's approximately 3.2 million. If you annualize that, we're looking at somewhere around 4 million. The most important thing to remember is that we continue to focus on keeping our total indirect OpEx, however you want to call it, indirect costs below 10% of revenue as we move forward. So, we had mentioned during the IPO phase, we will need to invest for sure. This transition from an SME, privately held company, to a listed company will mean that our cost structure will, in the near term, there will be a small step shift change as we gear up. But we believe that will, with the growth that we expect over time, that's fully absorbed and our costs will be low, indirect costs will stay below 10%. So hopefully that answers your question, and if anybody else had a similar question.
Yeah, that clarifies it. And just one final question from my end before I jump back into queue. I just want to understand the business better in terms of the automotive sector better specifically. You've mentioned multiple times that for this year, FY26, you've had abnormal order timings. We just want to know from your end, what do you think the reason behind that is? Is it a shifting consumer behavior, your client behavior? Is it more of a structural shift, or maybe a seasonality shift? We just want to get your thoughts on that.
Yeah, Abdul Wahab, let me take that question. It's obviously we have seen that in the past, our second half was always stronger than the first half in terms of revenue, because the orders would usually happen after summer holidays or closer towards the fiscal year end of our customers. And this time we haven't seen that. We haven't seen that. Some companies told us, they have invested their budget in different applications. Others said that the cash in the market is not coming around as fast, and that they want to delay that. But fundamentally, the tailwind which we are talking about higher regulations, about more people being here, so more people needing food, so more transportation, that fundamentally doesn't change. Whether it is a longer term slight shift, I personally, from my 8 years experience, I doubt that. But it's certainly also that Ramadan has shifted 10 days every year, and the need to have, during the Ramadan season, new trucks on the road becomes potentially a little bit less than if it would have been 3 or 4 years ago. So maybe that's influencing a little bit the order behavior of some of our customers. Does that answer your question?
Yes, that's correct. I'll jump back into queue. Thank you.
Thank you very much.
Thank you. We have no further audio questions. I'll hand over to Ali to go over any written questions.
Thank you. So our first question comes from Saady from Al-Rayan Investments. What's the gross margin on the stationary refrigeration segment?
Ruben, would you like to take that?
Yeah, I'll take that. I think for those of you that were involved with us in the IPO stage, you know that, as we mentioned, our stationary refrigeration business is operating in the low teens from a gross margin perspective, and that's not something that we expect to change in the medium term. So that is the range. Every project is slightly different, but we're sort of in the low teens, and that's the lowest gross margin that we see across our 4 segments.
Thank you. Our next question comes from Zoe from Virgin Asset Management. Can you please repeat what you said regarding the CapEx guidance and why you expect it to be lower? What has been deferred based on the financing considerations?
Sure, Ruben, go on.
Yep, I'll take that. So normally we have 2 types of CapEx, as I've mentioned previously. We have our sort of ongoing, month-to-month CapEx, maintenance-wise, upgrades, etc. And normally we spend on average, and it's on average because it's not happening exactly the same each year, 6 to 7 million. This year, in anticipation of having such a sort of heavily skewed revenue to the second half, we alluded to this concept of 1/3, 2/3 earlier in the process. That's exactly what it looks like it's going to turn out to be. Well, knowing that we had such a back-end loaded, revenue picture, we've deferred some of those normal maintenance type CapEx things that are not urgent to Q1 or the first half of next year, simply because we need to maintain, optimal factory uptime to deliver on this Q4 revenue. So that's the simplicity of it. It's just a deferral. We're not fundamentally changing anything that we would normally do. If the question is more about our CapEx for the facility expansion that Peter referenced, the process is going a little slower than we anticipated in terms of, the financing that we're securing, etc. That process we thought would be wrapped up by now, but it's still ongoing, and so that's a natural sort of deferral just based on where we are in the process. So we're probably a quarter behind where we thought we would be. And we mentioned during the IPO phase that we would only really start investing at the very tail end of Q4, sort of February, March. So, it looks like we're going to be at least a quarter out from that. So again, nothing fundamentally changing in our plans today, just working through that process to get to a solution that we're all comfortable with.
Thank you. Our next question comes from Khalid from SMB Capital. You had previously guided that the second half would be stronger than the previous year. However, we saw a flat top line and decline in margins with a decline from revenues from the high margin automotive business. Could you please clarify what happened during the quarter and clarify your outlook beyond?
Yeah, let me take that question first, the fundamental quarter, and then maybe Ruben, you can take the financial part. So, in the third quarter, we have, during the IPO phase, anticipated that we have a strong growth over the first 2 quarters, which I think we demonstrated. We accelerated significantly in the revenue generation. For the third quarter, we almost created as much revenue as in the first 2 quarters together. We always knew and saw that the second half would be stronger. Some of it is a little bit timing shift, that some orders came in a little bit longer, or engineering work took a little bit later, that shifted them more towards the fourth quarter. But fundamentally, I've seen the guidance which Ruben presented. Fundamentally, we are still believing that we can create a very, very strong fourth quarter. Our business is sometimes that way, that if a ship, for example, delays, title doesn't change, that means we will not be able to recognize revenue at one particular time. That has nothing to do with the fundamental strengths of the business. Now, Ruben, if you would like to talk a little bit about the financial part of the question.
Yeah, look, Peter, I think you answered the question entirely. There's not much more I can add. So we had signaled during the IPO phase, our second half would be significantly stronger. Is there some movement, timing movement within the second half between Q3, Q4? Yes, that's clear. But does it fundamentally change the fact that we're going to deliver growth year over year? No. So I think you've answered the question completely from your side.
Thank you. Our next question comes from Gladys from Real Capital. Since you have revised the FY26 guidance downward, how does this impact your medium to long-term targets? Specifically, are the growth projections for FY27 and 28 still achievable?
Very good question. Ruben, I'll take that. Very good question. And no, actually, Ruben, why don't you take that since you are becoming the new CEO?
Okay, Peter, sure. Sorry to jump in there. I just got excited by the question because it's a good one. So yes, look, we have revised FY26 down. As we mentioned, it's timing. Nothing fundamentally changing in the market. So our growth will be, a couple of percentages lower in the range from what we said before. We told you during the IPO phase that we believe in the medium to long term, we expect to grow at 11 to 13% on average. Again, not guaranteed that we're going to be in that window of the year, but over a period of time, it should be sort of an 11 to 13% range. As we sit today, to be super frank with you, Abdulaziz, we are very focused on delivering a record Q4. This Q4 of revenue, if we achieve what we're expecting to achieve, if you go back 5-6 years, would have been the equivalent to a full year of revenue for CGS. And it's in the quarter with the least amount of working days. So the whole team, including Peter and myself, we're fully focused right now on delivering on our FY26 guidance. I think when we start looking at growth projections for FY27 and beyond, when we get to the full year results call, we'll be in a much better position than to guide on our growth projections for FY27 specifically. But what I can say is both Peter and I see nothing structurally changing in terms of our equity story, the tailwinds that we expect, the impact of Vision 2030, and how well aligned all of our segments are to take advantage of that vision and the growth that will come from it. So fundamentally, nothing's changed in the business. So you can see that timing can have shifts like we're seeing now, a little bit in terms of our revised guidance slightly. But we will come back to you in due course when we deliver our full year results to give more specific projections on 27. But what I will say is you saw me present the backlog slide. This will be one of the first times in CGS history where we have visibility into the next fiscal year and the one after in terms of revenue. So we're in a really strong position, I would say, at this point. So I think that's the best I can do to answer the question at this moment.
Thank you. At the moment, there are no written questions that haven't been answered by management. And I'd like to hand over the call to Nadia for any audio questions.
Great, thank you. As a reminder, if you would like to ask a question, please press star followed by 1 on your telephone keypad. If you have joined online, please use the Q&A chat box provided. And we have another audio question from Adnan Farouk of Jadwa Investment. Please go ahead.
Hi, thank you for the presentation and the call. I have a couple of questions. One, the backlog that you have shared that you expect to record during the fourth quarter, it seems that the customized solutions in the aftermarket segment will be a larger portion of your revenues than it has been in the recent past. If I were to take the midpoint guidance, it is going to be around 25% of the overall expected revenues in the fourth quarter. How do you think that would impact your margins? Because we know after-sales service is a high-margin business. What about customized solutions? Where would that land? If you can shed some light on that, that would be great. Secondly, just wanted to understand, because you have seen year-to-date performance, 9-month performance, the gross margins at 22.2. The full year guidance still remains 21 to 23% on the gross level. That could mean fourth quarter could be either very good or very bad in terms of margins. So if you could just, based on the backlog that you're sharing, if you could highlight how margins should shape up in the fourth quarter, that would be really helpful.
Ruben, would you like to take that?
Yeah, I certainly can. So look, starting with the first question about you said the midpoint correctly, you kind of nailed it, that it's going to be roughly 25% of the overall revenue for Q4. I've mentioned before in the earlier phase that our customized solutions is running at sort of, high teens, sort of 18 to 20% range. And I wouldn't expect anything different from Q4. As you correctly said, our margins in the aftermarket services business are significantly higher, 35% plus. So, I think you can do your own exercise offline to figure out what that's going to mean. But based on our guidance that we've given for the full year gross margins, given where we are today, I think, I would suggest there isn't going to be a major deviation from what we see year to date. So given the business mix we have, and you can see, if you take the midpoint of the segments as given to you on that slide, and you sort of do the math, I think you'll come to the conclusion that somewhere in this low 20s is where Q4 should end up, which, comfortably puts us within that. Maybe the range is too big, frankly, on what we showed for the end of the year, but we'll be within that range for sure.
Adnan, does that answer your question?
Yeah, and I had one follow-up on Peter. Can you give us some reasons on you have built this business ground up? What made you leave after listing the company so soon?
Sorry, I didn't understand that question. Could you repeat it, please?
So I was saying, we know the CEO, Ruben is going to be the CEO, you are transitioning. Just wanted to understand why so soon after listing have you decided to move on?
Yeah, look, this is a solely private decision. Over our festive period in Europe, I had long conversations with the family, and we have decided that it is time for me to spend more time with the family, and that was the reason why I have decided to resign. Fundamentally, I love CGS. I think we have achieved great things together. I would love to be part of the rest of the journey, but we all now know that sometimes you need to shift priorities, and family is important to me, and that's what really is the driver behind my decision to retire, hand the organization into the capable hands of Ruben, who I have no doubt will help shape the journey of CGS for the next several years in a very successful manner.
And one last question for Ruben. Ruben, you mentioned in the long term you expect indirect costs to be around 10% of revenues. When you say that should be the range we should expect for next year and the fourth quarter. Fourth quarter should be reasonably better because of the pickup that you're expecting in revenues, right?
Exactly. So fourth quarter, because of the amount of revenue we're going to push through, as a percentage of revenue, it's going to be significantly lower than the year-to-date in Q3. That's correct. And I reiterate, for the longer term, our goal as an organization is to stay lean. Of course, we need to be effective as well, so we will invest. But, to sort of invest along with our growth, the goal of maintaining our indirect expenses below 10% as we move forward.
Great. Thank you so much for your time.
You're welcome.
Thank you. It looks like we have one more written question, so I'll hand back to you, Ali, to go over this.
Thank you. So our final question comes from Ali Al-Nasser from Virgin. Given your year-to-date revenue performance, do you expect revenue to come at the lower end of the guidance for the fiscal year?
Ali, that's an important question, and we have selected our guidance in that percentage range very carefully. We expect that we will be in that percentage range, as I tried to explain before. Some of the revenue recognition is influenced by when a title for a certain product will be handed over. So we have certain products which we obviously produce and need to be handed over to the customer. This revenue is usually driven, amongst others, by whether chassis from the chassis supplier are available and that we can hand the product over just after Eid holidays, basically. The second part is where we have titles transferring after material lands in Saudi Arabia, and we have shipped the material to the customer site. That's particularly true in the stationary refrigeration. So depending a little bit on how the timing plays out, we will be either at the lower or at the higher range of our guidance. So I would really calculate that or base it on the full range, your consideration on the full range which we have given.
Great, thank you. It looks like
Peter,
we have
maybe
no
if I
further questions. Sorry, please continue.
Sorry, if I can just add, one comment maybe to Peter's point. I think just to sum it up, that range is there specifically for the topics that are out of our control. So everything that we have within our control within CGS, we are executing, and that's why we'll have a record quarter. That range that remains is, to Peter's point, driven by external factors that we're monitoring and, of course, trying to manage, but that's where the variability is. And unfortunately, from where we sit today, even with how much time we have left, given all the activity that's happening on so many fronts across all segments, it is difficult for us to give you anything more specific at this point.
Great, thank you. It looks like we have no further questions, so I'll hand back to Peter for any closing comments.
Yeah, ladies and gentlemen, thank you very much for your interest in CGS. I hope that you have seen that our business and business model is fundamentally strong, that we are benefiting from very strong tailwind through the transformation with Vision 2030 and the young population which drives population growth here in the Kingdom of Saudi Arabia. I think once again we try to demonstrate why CGS is a very strong investment case. I think our growth targets, the mid-range development plans over the next 5 years are, in our opinion, still super realistic. And as Ruben said, we will provide the further guidance once we have the full year closed and do our annual presentation. But thanks again for your interest and those very important questions you have asked. Wish you all a very good rest of the afternoon, and talk to you in a few months' time.
Thank you. This now concludes today's call. Thank you all for joining, and you may now disconnect your lines.